Tim, you're now the CEO, you know. CFO, that's me, and you wait, and then we go to the stage. Good old times, no? You want to do it? Come on. Okay, warm welcome again from my side here. Before I get started, you know, I always enjoy the US team here being on stage, but I enjoyed as well, to be honest, the German and the EU side. I'm pretty sure there are a lot of US people here in the room as well, and what the US guys completely missed is to ask those of you who are coming from the US who's still not on T-Mobile, that you have the opportunity in the next break to change that. So whomever here in that room missed it so far, think about the roaming stuff. You can have a chance afterwards again. So what I'm going to do with the last presentation, it will be around 30 minutes, and then Tim, Stefan, and myself, we will take your questions and have a Q&A with you. What I like to do is the next 30 minutes to summarize what you have heard during the course of the last, basically 24 hours, and do it in a very condensed way. You know, we've talked about general trends in telco, about the challenges, what we want to do, how we want to differentiate, et cetera, et cetera. And I try to bring that all together in a comprehensive way that you also get the financials and clear, that you have a clear view on how you can track us on our earnings calls quarter by quarter, and that we're talking the same language. So let me start with the key message. The key message is not showing up. This is not working, guys, so you need to click somehow. There's nothing I have on my... Okay, so you take care here, and I go on. The key messages, basically. Here we go. Okay. So, first, number one, DT is leading European telco. I think Tim was clear on that one. Our perspective, how that company should evolve and how a successful operator in a European landscape by the end of the decade should look like to secure superior margin, is an integrated player having control on fixed line and mobile, being number one in B2B and B2C. It's not only a consumer game, it's always important to have B2B successful in the game as well. And clearly have integrated in a way that we can play the strength of that superior production model. Second, clear message, differentiation. It is of utmost importance that we get that differentiation done, and there are two areas of differentiation. One is network experience and quality, and the other one is customer experience. It is not like in the past being the best and the number one in video portals, music portals, and so on. We're going to, via partnering, choose the best players, the best owners of those categories, but we concentrate on network experience and customer experience. Number three, during the course of the next years, we will, faster than all the other big European players, transform and change our production model in a way that we come to a highly agile and lean IP production. And I mentioned yesterday, and I think Claudia did it as well, linked to that, we have upsides like 1.2 billion of reduced of OpEx in a steady state, but also tons and lots of upsides looking at the customer experience. Number four, we will fund that transformation during the next years, where we have investments to do, by rigorous and disciplined cost management. And you will see at least a minus 1.8 billion indirect cost reduction. I'll come back to that in a minute. That's number four. Number five, and that's very important again, we will grow in all relevant financial KPIs during that transformation. So we're talking about the revenue, the EBITDA, the free cash flow, and the ROCE here. And for us, it's clear that you as a shareholders, you will participate with the growth of dividend following the free cash flow growth, and our prudent debt policy remains unchanged. So that's basically the key messages. For the sake of time, knowing that you're keen on Q&A and not so much on review 2013, 2014, I will skip that one, just reminding you that the total shareholder return since the last capital market days was 108%, that we delivered on our dividend promises we've made, and that we've Still a safe haven for the debt investor side. If you look at the ranking on the left-hand side, on rating-wise, or if you look at the CDS, 5-year CDS, you see this is where we should be and this is where we are. So still being a safe haven here for the debt investors. So let me come then to the financial strategy and repeat and bring that, as I said, all together that you get the numbers right. And let me, the framework I'm going to use to tell you again is the one you know. It's the financial strategy. 3 key elements in the middle part: the strategy of the company with the value creation, ROCE above WACC. You see on the left-hand side, being reliable to shareholders and having, hopefully, an attractive remuneration policy, and on the debt side, undisputed access to debt capital markets. On the debt side, nothing has changed, though I keep that very short. In the mid part, some topics have changed since the last capital market days. Just to remember you, one is infrastructure transformation. We talked about that a lot yesterday, and I summarize it in a minute. The second one is cost transformation. Same holds true here. On portfolio management, I will not repeat anything. I'm pretty sure you have enough for the Q&A on that in that area. And a few words on risk management. This is not new in the middle section. And on the equity side, as you've seen it during the course of yesterday already, our dividend policy, the dividend following the free cash flow growth, with a minimum floor of 50 cents per share. Okay, so let's go a little bit through those topics and items, what you have seen and what you should remember. I start with the middle block, with the value creation, ROCE above WACC, and I start with the infrastructure transfer. No, I start first of all, sorry, with a summary. On the value creation side, obviously ROCE above WACC. You've seen 2014, a 4% ROCE excluding the Scout transaction and a 5.5% including the Scout transaction. That's the way you should read it. Just to remind you, 2013 was a 3.8, so a slight increase here on the ROCE without the transaction, and obviously a huge one including the transaction. So ROCE will be above WACC. How will that happen? Very simple. We see the revenue growth in the CAGR of 1 to 2%, the EBITDA 2 to 4%. We're seeing in parallel a cash CapEx increase with a CAGR of 1 to 2% across the group, and I'll give you a split in a minute to make you aware how that should play out across the segments. And the special factors I touched on yesterday upon when I talked about restructuring and how that will take place. So 13 a higher level, 14 a lower level, 15 higher, 16 a lower, 17 a little bit higher, and then 18 a lower again. That was that kind of profile I mentioned. Okay, so as I said, first element is infrastructure transformation. Infrastructure transformation, and it was on the slide before, shown that the CAGR should be 1 to 2%, or is in our planning 1 to 2% on the cash CapEx side across the group. So we are not planning for free cash flow growth by reducing CapEx. We are trying to make that free cash flow planning robust by continuously increasing the CapEx, because we know, give you an example, for instance, in Germany, Bruno talked about that, in 17 and 18, or partly 16 and 17 and 18, for instance, we will put super vectoring in place. That will, again, consume some CapEx. There's 5G coming up, and so on and so on. So the idea here is not to have those kinds of profiles, and then 2 years later we have to increase it again, but to put the money already in to be assured that we had the right level. On the German side, it's very important that you understand that we have, compared to last capital market days, if you compare it in the old, as Stefan always says, Bible of the capital market days 2012, there is a CapEx profile in Germany. And if you look into it, you will see, I think it's 4.2, 4.3 billion, for instance, of CapEx in Germany in 2015. Now it's like 3.8, 3.9, and you might say, okay, they have changed it. It is important to understand, we have changed the input, we haven't changed the output. It's the other way around, it's contradictory, we have put more output in there, so we deliver more than we have announced in 2012, but we do it with less CapEx because we have found clever ways how to manage that. Nevertheless, in Germany, you will see a CAGR of roughly 1% during the next 4 years. In the US, that's 4%. Obviously, especially in the US, that's very much dependent on what kind of growth level we see in the next years. So we have a planning, and that planning assumes a growth level, it assumes revenues, it assumes EBITDA, and it assumes a CapEx. But as you know, there's always a higher dependency in the US than in all the other countries on the CapEx level. What we've done is a CAGR, we put in a CAGR of 4%. We think that's appropriate. And we see a slight increase in 15. The US team has guided to 4.4 to 4.7. That's what you see reflected in here. And in Europe, you will see a slight increase now in 15, and you will see but roughly the same level in 2018 again. So that's the CapEx profile you should expect more or less across the group. And obviously, part of that CapEx profile is also to make that change here and that superior production model happen and assure that we can get the 1.2 billion of OpEx out of the structure in a steady state again from early 20s onwards. I don't go there anymore because you've heard a lot about that. What is of more importance to me, where I want to spend a few more minutes, is on the cost side, because after my presentation yesterday, I got the feedback, we're not pretty sure how to deal now with the 1.8 you mentioned, and the direct cost, and the 1.2. So I try to repeat it again to make sure that there is absolutely no misunderstanding in the room. The intention and the thought process is this one. We need to get, and that's our ambition, we need to get the indirect share of our OpEx down, and with that, obviously, the direct share up. The intention is, you see it from the beginning of this decade to 10 years later, to move from 2/3 of indirect costs of those costs who are not linked to the revenue, to move it down to 50%. And there are two phases basically taking place. The one phase is between 14 and 18. That's the phase where we're talking about the minus 1.8, and I come back to that in a minute again. And there is a second phase after 2019. We will not stop with cost reduction. I can tell you, in this company, we will never stop. That's what I'm telling the employees after they have asked me several times, when will it end? And I said, it's easy to remember, never. It will not end. As long as we are here, it will not end. So it is not like we're doing something till 18 and then it's done. No, we're doing something till 18. That's the 1.8 I will talk about in a minute again. And then we will again do something additionally to reduce the cost from 2019 onwards. And part of that cost reduction is the 1.2 you've seen from the production model. So let me go to the 1.8 again. Explain it again, and then jump back and clarify finally, hopefully. If you look at the left-hand side, adjusted OpEx, that's the adjusted OpEx bar. We exclude the gray part, being the US, for the reasons you know, and just concentrate on the magenta part. And what we have done here is we're looking at the OpEx before capitalization. Because what I want to do is look at, in the first instance, I don't care whether the costs being capitalized or not. In the first instance, I care that they are there, that we need to manage them. So that's the way we look at it, and that's what you see on the left-hand side. And you see the 29.7, and I just want to do some math with you to make it crystal clear how it works. Let's assume we have a CAGR in the direct cost, or a CAGR in the direct cost of 1.5, so in the mid-range of 1 to 2. You see the 1 to 2? Let's take the 1.5 as an example, mid-range. So we have revenue growth, ex-US, and with that revenue growth, you see some direct cost growth like 1.5, just for the math. In 4 years' time, that will sum up to 600 million. So 1.5 times 10.4 times 4 years, you end up with 11 billion of adjusted direct cost, as an example here. In parallel, you will see a reduction of the indirect cost from 19.3 down to 17.5. So in that case, if you sum it up all together, you end up with 28.5. So you would have a net OpEx reduction, indirect and direct, in total of 1.2 billion. as an example, while revenue is growing. That's the way you should look at it, that's the way you should calculate it, and that's what you can expect for 2014 till 18 in our reported figures. So hopefully now it's crystal clear, that's the way you should take it. And this part is exactly what's taking place in the framework here, in that frame here, 14 to 18, and again afterwards it will not stop. Was the US guy saying it will never stop, and that's true here as well. Okay, so that's the way you should take the message on the cost. And as a consequence, obviously, you will see impact, and that's more for your information and for your notice. You will see the impact on the EBITDA margin, EBIT margin. Maybe a few words on the depreciation, because they're flat. Some of you might have assumed so far that they grow because we invest more, so as a basic reaction, you would expect that they grow as well. But we have, especially from the European segment, some counter effects, so you should expect them to stay more or less, not more or less, to stay flat. And the EPS, as a consequence of that, will also then grow, as you see, towards the €1 in 2018. Okay, so that was on the second part on the cost management. As I said, I skipped the portfolio management and go again for a few minutes on the risk management. We've spoken already about OT and also a little bit about the US, but I want to give you the complete picture. I'm not sure whether you are aware about that picture. Tim has shown that in his old role 3 years ago with that green, yellow, red categories of economies and where we're operating in. So to indicate what kind of environment we are indicating in. And basically what you see is, if you take first of all the left-hand side and you see the sum of the parts share being in green and yellow, that has improved from 85. It was already high 3 years ago, but it has further improved to 91%. So those parts of our operations in terms of value we're having existing in areas where we have green and yellow economy risk situation, they have improved by 6%. And on the other hand, on the critical part, on the right-hand side, on the red ones, you've seen they've moved down from and declined from 15% to 3%. So again, a message. Tim yesterday said we're lucky because somehow also because we are in a German stable environment. That is not only German stable environment. You see here that is a complete more than 90% being in very stable and good environments. So I think that's also important to understand. And about T-Mobile and OT, I think we've talked that through already. On the risk management, another element I want to talk you through is, because I continuously got questions around it, is about the pension payouts and the pension funding. I think especially because of there was always a focus point on the BT side when they had their pension funding, and everybody was looking at what are the others doing on pension funding. So let me show you here for DT left-hand side. This is for our German, where it's most relevant, German footprint. You see the payout for pensions between 2015 and 2025. And the two colors indicate the civil servants part and the pension plans. The good news is, for us and then also for you, is that on the civil servant side, there is absolutely no volatility. That is something I can calculate exactly, because the amount I have to pay is fixed. The number of people are well known because there's no new inflow, there's just technically saying outflow of the population here. And as I have no new hires, the contribution is fixed. I do exactly know the population and when the population will leave. So that is something I can calculate exactly, and there's zero volatility on that one. So the basic message to you is, on the left-hand side, is on pension payout, because that was one of the debates we had internally as well, talking about how robust is our free cash flow guidance we give in. Obviously, we had a look into that, and again, I want to reassure you here on the pensions payouts, we will see a slight decline, or more or less the same level. It's a little bit lower, but basically the same level. So that's the left-hand side. Then on the middle part, there are two elements. One is the defined benefit obligations, the gray one, and also our planned assets you see here. Our plan was, and that was something we have announced also, I think 2 or 3 years ago, to do a funding ratio up to 50%. That was based on roughly a discount rate of 3%, 3.5%. We are now at 23%, and you see we are moving forward into that 2020. Obviously, that depends whether we match 50 or whether we have 45 or 55. That depends on the discount rate. I think the most important element for you is, other than, for instance, BT, our funding is completely and entirely voluntary. There is no obligation to us in any way to do that. What we want to do is do that funding. That is why we have announced it. That is a share of roughly 250 million per year we take and put in there. That is what we have done in the last years as well. That is after free cash flow. So the way we deal with free cash flow is there's free cash flow, and then there is the money we take for pension funding on one hand and spectrum on the other hand. So it's after after free cash flow. But you should know that is the situation we're having. Then on the gray part, you know, what happened is, as you all know, discount rate declined strongly during the course of 2014. From 2013, end of 2013 to end of 2014, we moved from 3.3 to 1.9% in discount rate. And with that, as you see here, the DBO went from -9 to -10.9. So basically, the deficit increased here. And on the right-hand side, you see the sensitivity is more or less only on the discount rate. So all the other elements are not really of relevance in terms of sensitivity. It is about the discount rate. I think what you should know is we've doing that whole exercise very conservatively. So the discount rates you see in the DAX, as an example, are between 1.9, that's the lowest, to 2.5, 2.6. That's the highest. And you remember ours is 1.9. So we're in a very conservative way here to deal with that discount rate. So I think that's what you should know. The basic message is on the pension payouts, slight decline, you see it on the left-hand side, and funding voluntary, what you see in the middle. Okay, that's it basically on the risk side. Then moving from the middle part, value creation, to equity. I think Tim mentioned that yesterday, 6, 7, 8 years ago. And I can tell you, I'm with the company since 23 years. It's not so long ago that most of the people have not been incentivized along the line what matters to shareholders. And basically that has changed in the course of, I can say that was the time when Tim was CFO. He was heavily pushing forward to that we align short-term incentives, long-term incentives, in a way that it's very much aligned with the interest and with the shareholders' interest, and that we put shares in as much as we can. So just to cut the story short, on the short-term incentives, for instance, we have the group free cash flow in there. We don't have adjusted EBITDA anymore in there, but we have all the restructuring costs as well in there, so that the operational people take care about restructuring as well, because it's a huge element of our equations here. On the long term, it's ROCE adjusted EPS as 50% of our incentive. The other one, as you see in the gray part of the circle here, is customer and employee satisfaction. And on the left-hand side, the third one, the share price. And we have share matching plans now, and it's not anymore a few tens or low hundreds of people having that, but as Tim mentioned yesterday, it's now thousands of executives and leaders having that in that company. And I think it's good to have that, because you feel that this better alignment between shareholder interest and the leadership team, that changes the behavior in the right direction as well. So that's one element on the equity side. The other one is the message you hopefully got already right. That is, our guidance for the free cash flow next 4 years is a CAGR of 10%, and the dividends following the free cash flow growth. So as an example, because I got the question yesterday in the T gallery several times, as an example, if 2050, and let's assume the free cash flow grows by 4% or 5%, then our intention is to let the dividend grow at the same rate. And what we're saying also is we put a minimum floor of 50 cents in there to assure everybody that there is a, so to say, there is a minimum level, but we want that our shareholders participate on the free cash flow growth. Okay, so that's equity side. On the debt side, left-hand side, upper left-hand side, nothing new. But sometimes to be remembered and reminded, like to remind you, undisputed access to debt capital markets is of importance to us. That's why we're continuously in dialogues also with the rating agencies. We listen to them, and we're also trying to make sure that they feel comfortable with our ratios as well. We are in our comfort zones, and you see on the upper right-hand side, along the timeline from 14, 15, 16, 17, how that should evolve. On the left-hand, lower left-hand side, the maturity profile, you see we're in a pretty good shape here, and I think the rest speaks for itself. So, in a nutshell, what are we talking about? We're talking about growing revenues, growing EBITDA, growing free cash flow, but also growing cash capex, which I think is good news, that you invest more and you get more out of it. That's good. The special factors I mentioned several times, you should be comfortable now with them. D&A as well, with a slight increase by more investment compensated by some elements from, especially from the EU segment. And obviously, tax then increasing while the adjusted net income will also increase. With the consequence that we have a ROCE above the WACC, and with the consequence that we will make sure that the dividends follow the free cash flow growth with the floor, you know. Okay, so let me again finally show you our guidance for 2015. And as you know, this time with $2 exchange rates in the middle, the one who makes it easy to compare to 2014, as it is the exchange rate, the average exchange rate we had in 2014. And we guide towards a growth in revenue around 18.3 billion of EBITDA, of adjusted EBITDA, and around 4.3 billion of free cash flow. And then to make it easier to you to reflect it to the current situation in terms of the exchange rate we have in 113 as an example here. Again, the growth on the revenue, on the adjusted EBITDA, 1 billion more, meaning around 19.3, and the free cash flow around 4.3. Again here, because I got several questions, the message is not that the impact of the US in the free cash flow is zero. That was a shortcut some of you took already, but it does mean that the share in there is so small that the delta in the exchange rate doesn't change the 4.3 to a higher number. And that's obviously driven by high interests we're having from the US due to self-funding strategy. Okay, and then the midterm ambition level again, and afterwards we will jump right into Q&A with Tim and Stefan. Group revenues, 1 to 2%, EBITDA, 2 to 4%, free cash flow CAGR, as all CAGRs, around 10%. The adjusted EPS around €1 in 2018, the ROCE then above the WACC. We will earn our cost of capital. The cash capex continuously growing with a CAGR of 1 to 2%. The decrease ex-US in the adjusted OPEX with the math I've given you a minute ago, and the dividend policy, dividends following the free cash flow growth, and at least a floor of 50 cents per year. Okay, having said this, I am done, and now I think it's time for your questions.
So, well, I think we got about half an hour for Q&A, so that's well done. And I